Look at you. You're on your way to becoming an investing genius. You now understand what the stock market is and why it's such a great place to invest your money. You now know how to invest in the stock market through ETFs, of course, and you know when you should invest in the stock market for long-term financial planning and to achieve your long-term financial goals and to create wealth. But investing has certain golden rules, the rules of the game. They're simple to understand but difficult to implement. So pay attention. Rule number one, start investing early. Let's say we have an early investor and a late investor. The early investor starts to invest 10,000 rupees every month at the age of 25 and he continues to do this till he turns 60. The late investor too starts investing 10,000 rupees every month. But he, on the other hand, starts at the age of 35. Like the previous investor, he also continues to invest till the age of 60. Now, if we assume that both the investors made a return of 12% per annum, then the late investor made a return of about 1.5 crores over these 25 years. That's a pretty neat corpus for retiring. However, by starting early, the early investor would have made about 6.5 CR over the course of 35 years. That's about 3 times the return made by the late investor. That's just insane. So start early, start today. Every month or every year that you're late, you're potentially missing out on making a few lakhs more. Rule number 2, invest for the long term. The stock market is quite volatile. Now in fixed deposit, you would know what return you're getting every time. But in the case of stock market, the returns are very uncertain. But you never know in advance what to expect from the stock market. Many have tried and failed to time the market or make abnormal returns. And others just hop in and out of the market based on instinct and data. However, there is a simple solution to combat the volatility of the stock market. Invest for the long term. Let's consider 3 time periods: 1 year, 5 year, and 10 years. Now, had you invested in Nifty 50 for just 1 year, your returns would have been between minus 35% to 85%. That's some volatility. Simply put, if you invest your money in Nifty 50 for a period of 1 year, you don't know what returns you can expect to make. It could range from really bad, which is negative 35%, to really good, which is 85%. Now, had you invested in Nifty 50 for a period of 5 years, your returns would have been anywhere in the range of minus 3% to 37%. Still volatile, but better than investing for just 1 year. And lastly, had you invested in the Nifty 50 for a period of 10 years, your returns would have been anywhere in the range of 5% to 19%. That's a much narrower range and should be acceptable to most investors. So, as the investment period increases, 2 things happen. Number 1, the chance of generating a negative return is significantly lower. And number 2, the return that you are likely to make is much more predictable. Rule number 3, diversification. Don't put all your eggs in one basket. That's diversification. What it means is that don't invest in one or few of something. Don't invest in just one stock or few stocks, or in just one asset class like stocks. In the next video, we'll see that there are many asset classes and using as many of them in your portfolio will be of great benefit to you. But let's look at a couple of other golden rules of investing before we talk about diversification in detail. Rule number 4, low cost is your best friend. Now, investing isn't free. If you invest in mutual funds, the mutual fund company charges you a fee. If you invest in stocks, you have to pay a brokerage. And obviously, if you are giving someone else to manage your money, you have to pay them an advisory fee as well. The investment management industry will charge you a fee even if you sneeze. But higher fees translate into superior performance very rarely. In most cases, this fee reduces your total return because now this fee, which should have found its way into the stock market, finds its way into the pocket of your financial advisor. All you got to remember is to be aware of the charges and taxes levied at every stage. Actively try to reduce these charges because in the long run, it will only benefit your portfolio. Active mutual funds have a fee of about 1%. Portfolio management services or PMS services have a fee of 2.5%. ETFs, on the other hand, have a fee of just 0.1%. ETFs track market indices that are unlikely to be beaten by professional fund and portfolio managers in the long run. We saw this in one of the previous videos. So you don't have to be an Einstein to figure out that low cost ETF is your best bet to make good returns in the long. Rule number 5, don't pick stocks. Now you already know that you don't have to pick stocks, but we were afraid that you might forget it. So we just want to repeat it one more time. Don't pick stocks. Invest in index tracking ETFs. So let's review the golden rules of investing one more time. Number 1, start investing early. Number 2, invest for the long term. Number 3, diversify your investment portfolio. Number 4, try to reduce your costs wherever you can. And number 5, don't pick stocks or pay someone else to pick stocks for you.